Yes, we are also now joined by a famous investor, astute investor, and someone who really has seen emerging markets for a long, long time. Mark Mobius is founder at Mobius Capital Partners, and he's joining us right now to take some questions. Mark, great to have you always here on CNBC-TV18. It's been a while, a bit of a gap, and since then so much has happened, right? In June, the markets globally made a bit of a bottom. We got a trading bounce. That has gotten sold into, especially viciously in the US. How are things looking to you now, starting with US and the impact that we will see because of what's happening there?
Well, first of all, thank you for those kind words. Regarding the US, I've been saying for quite some time now, the Fed is going to continue raising rates. And that, of course, is putting a damper on the market. People must remember that the playbook for central banks around the world, particularly the Fed, is that they want to raise interest rates above the inflation rate. Now, the inflation rate that they use, of course, is the CPI, the Consumer Price Index, which now stands at about 8%. That means interest rates have to go to 9%, of course, if the CPI stays at this level. So I think more is in store for the markets. And as you know, for the S&P 500, we're right at the support level. If it breaks below this support level, then we're going to see more blood on the streets. The interesting thing is that India is really bucking this trend. It's amazing what the Indian market has done. And it speaks very well for the policies that the government has pursued, and the general buoyancy of the Indian market is very good.
Okay, Mark, hi, good afternoon. So what are you buying now in India? Because we have seen a clear shift. IT, which was leading the rally for 3 years, has taken a big backseat while banks have started to outperform.
Well, we're looking at both software, persistent systems, for example, would be one. And we're looking at infrastructure-related stocks like Apollo 2. So these are the kind of stocks we're looking at. And we think those are the stocks that will perform very well going forward.
Hi, Mr. Mobius. In the past as well, you've been bullish on both those two names. But, in terms of approaching equities globally, I think Taiwan was one of the highest allocations, India and then China. How have things changed for India? Have you increased weightage in the last few months? If you could give us a broad number out there. And also, is India now top of the pack?
Well, I think India is really beginning to take more and more manufacturing share from China. And I think the government policy, the so-called Gati Shakti policy, speeding up the bureaucracy is going to be very, very good for India. You're going to see more and more companies moving manufacturing to India. And as you know, Apple has moved its latest iPhone manufacturing to India as well. So I think these are very good signs going forward. So we're going to be on the lookout for companies that manufacture this kind of equipment, and also companies that are going to contribute more and more on the software side.
Weightage on India has increased, though, Mr. Mobius, in the last few months, since things are looking, on the policy front, the economy as well has recovered quite a bit. Have you increased weightage to India? And what's the pecking order now? Taiwan used to be number one, I think, in terms of exposure. Has India overtaken Taiwan now?
No, not yet. We, of course, continue to look at India for possibilities of additions. But as you know, in our portfolios, we move very, very slowly. When we have a stock that we think is going to be good, we hang on to it. And that's the reason why, for example, the stocks that we have in India, we haven't sold. We continue to hold them. And the same thing is true in Taiwan, although in Taiwan, the weighting has been pretty high. So we want to reduce that by either decreasing Taiwan or increasing other countries like India.
Mark, you'd given us this thesis, and we kind of explored that in some detail about emerging markets generally doing very well, and foreign outflows out of India because of that, not country specific, and how there were some global funds now who were launching mandates ex-China, etc. Are you still seeing that? That is one. And second, later this month, in the middle of the month, we have that big party conference in China. Many are expecting that, once that is done, they will kind of completely, dramatically change their policies in terms of zero COVID, and attitude towards businesses, the crackdown there, etc. So there will be a big shift post that. Would you agree with that? Go on.
No, I don't think the policy mandates in China will change very quickly, particularly if she is re-elected and becomes the paramount leader again. So I don't think there's going to be a big shift. However, the Chinese are well aware that they need to have more dollars flowing into the economy. They need more funds to support the economy. So they will do their best to attract foreign investors, but within reason. The problem is for them is the reluctance of many investors to go back into China. I mean, we've been in client meetings where we say, well, we want to talk about emerging markets. And immediately the clients say, we don't want to talk about China, talk about anything else except China. So a lot of people have been burned in China, which means that India is in a pretty good position. Of course, the problem with India is that up to now, they've been rather restrictive and the market is rather smaller, less liquid. But the interesting thing is that if India is added to the various bond indices, emerging market bond indices, that could mean more and more flows into the Indian bond market. And of course, that could be accompanied by more flows into the equity market as well.
Okay, Mark, the other issue which is dominating headlines, or at least financial headlines, is what's happening in Europe with Credit Suisse and even with, DB perhaps. Do you reckon this could snowball into another Lehman, or do you think it's much smaller?
That's quite a surprise. And the fact that, you have a bank like Credit Suisse in the news is regarding that. But what it does is it begins to have people start thinking about emerging markets and thinking, wait a minute, emerging markets have been considered very risky and so forth. But how about these big banks in Europe and America? What's the situation there? So in some ways, it's quite favorable for emerging markets and for India, where people begin to think, well, maybe we should diversify a little bit away from Europe and away from the US.
Mark, I request you to stay on. Now we need to take a break and we'll come back and address more questions. For now, the Nifty is down 200 points and the Bank Nifty is down 600 points at the lows of the day. We'll come back and we'll continue this conversation with Mark Mobius.
Okay, welcome back. I mean, it's a 200-point cut right now on the Nifty, 16,891 at the absolute low point of the day is what we have. We're in conversation with Mark Mobius. Mark, sorry, that point that my colleague Anuj was asking you about Europe and Credit Suisse, etc. Do you expect an accident to happen or no? Not this time.
I don't think so, but of course I've been wrong many times before when I said things like that. No one really knows, but my thinking is that it's probably not going to happen because central banks around the world certainly don't want this kind of event to take place, so they will do their very best to support these large banks. Nevertheless, it's a warning for many people that we have to be careful. Even the big boys can get into big trouble.
Well, Mr. Mobius, you've mentioned a few stocks in the past, Polycab, Apollo Pipes. I think, the other one that you just mentioned was Persistent Systems as well. Any additions you've made with regard to the Indian markets as well? And I recall when we spoke earlier in 2022, when we spoke about real estate, you said you'd rather not take a direct exposure. You played via the cement route. Now, a lot has changed since then, and cement stocks out here have done very well. Any exposure out there?
No, not yet. We haven't found the right combination of factors in these companies to make us bullish. We look at things like return on capital. We look at debt. For example, we don't want to have companies with debt. And of course, you have earnings growth. So the combination of these things is not easy to find in any market. But I think in India, we'll probably be able to find more and more going forward. But not at this stage, at least.
The other issue is about the Fed pivot or the Fed put. What's your view on what's happening in the US? Because inflation still remains quite a serious issue, still above 8%. But a lot of people believe Fed may have already overshot in terms of tightening. And it's a tough question, right, to deal with. But what's your expectation over there?
Well, my thinking is that the Fed will continue to raise rates as the CPI does not really come down. You must remember there's been sort of an artificial downplay on the CPI because the government has released the strategic oil reserves, and that has pushed down the price of gasoline in America. But this is going to be temporary. I think after the election, prices will come up again. So I think all these factors makes me think that the Fed will continue to put pressure on those interest rates and raise rates aggressively. Another thing you must continue to remember is that cryptocurrencies are a big thing, not only in the US, of course, but globally. They represent, according to our estimation, about 2% of money supply. That may seem to be small, but the velocity of cryptocurrencies is quite remarkable. So there are a lot of people in America and elsewhere that are spending cryptocurrencies, which they found very, very cheap when they first bought them, and now they're making a lot of money. They feel rich, and they'll be continuing to spend in that way. In my recent visit to the U.S., I didn't see any let-up on spending. The planes were full, the tourist spots were full, the theaters were full. My feeling is that this kind of spending is probably going to continue for some time.
So that's an important point. What you're saying is stop looking for a pivot at every given opportunity, right? Because the market seems to watch on to any bit of slightly soft data to say, well, this is it. A pivot is coming. I mean, for example, I think there's a closed-door Fed meeting later today, which I think is a usual scheduled occurrence. Markets got very excited saying, well, pivot may come later today. Would that be the right way to look at it? Well, they are going to do what they said they will, which is bring inflation down to 2%, and only then will they rest. When they're convinced, basically, so nothing now. Mark.
Well, I think they're convinced of that. They, of course, continue to look at it. The pressure on them is terrific. You must remember, regardless of what you say, the central bank is subject to political pressure. And, of course, the current administration in America does not want to see interest rates too high. They don't want to kill the market. So there's a lot of pressure on the Fed. Nevertheless, their mandate is to bring that inflation rate down, and they're going to do anything that it takes to do so.
Well, Mr. Mobius, final question then. What about the erstwhile darling gold? You have said in the past it's been prudent to have some gold in your portfolio. Given the kind of variables at stake globally, what's your reading now?
I still think that everyone should have some gold in their portfolio, not for speculative purposes, but for safety purposes. In other words, when things really go very bad, let's say Credit Suisse announces bankruptcy, or one major bank globally announces bankruptcy, then things will get very bad, and it'll be good to have some gold in your portfolio.
All right, Mark, always a pleasure to talk to you. Thanks a lot for joining us today. Thank you. The word from Mark.